98% correlation. What makes this chart so shocking for all of us as traders and investors? And how could it all end? The dot-com bubble versus the AI bubble. In today's video, we need to talk about what's going on right now and why delinquencies starting to rise need to be paid attention to. And this all happens ahead of earnings season. With the S&P 500 about to hit our trend line, Bitcoin breaking out, and one of our favorites, silver, creating a squeeze, how much crazier could things get? Join us, guys, as we go through everything that you need to know for the week ahead, including stocks, commodities, and cryptos. This one is not to be missed. There's a lot to get into. See you in a moment. Well, welcome back, everybody, to the special weekend edition of The Daily Show. My name's Tom, and if you love markets like we do, remember to subscribe to the channel. Today, we have a bit of a special one. We're going to break down three main areas to look at this week. Number one is going to be bankruptcies and delinquencies. Number two, what is exactly going on with this form of cycle? Are we starting to see highs coming into the big earnings season? And number three, where does Wall Street believe valuations should be at? And what are the options movements expected for this week? Guys, a lot to get into, so let's kick things off straight away with bankruptcy filings. And it looks like some of the major sectors here are starting to see problems once again. According to the latest data taken as of July, we have industrials and consumer discretionary starting to show signs of cracking. And more importantly, this is basically just bankruptcy filings coming through in these primary sectors right now. Now, this is a massive increase in bankruptcies, and it's a mixture of higher interest rates for longer, but also it's a mixture of things just starting to slow down. And I think in many ways, AI starting to cripple certain areas of the market, along with tariffs. Now, of course, tariffs take between 1 to 4 months generally to start to show up in the economy. We're now at the 4-month period, and as we've long suspected, this is going to be the quarter moving forward where we'll see whether that 10% blanket tariff and indeed any of the new ones that were added potentially last week are going to start to affect the markets. Now, where are we seeing the big effects? Well, I would love to do a special on this, and you guys let me know if you want me to, maybe during a live stream. But I'm starting to see signs of issues in the Sun Belt in America. And this comes off the back of Airbnbs being closed down, people actually getting foreclosed on, and a whole bunch of new data coming out about mortgages, particularly in that area. Now, it turns out that the delinquency rate on single residential mortgages are still pretty low, but we're about to get an update. As of late July, August, this will be updated. And as you can see, based on the latest data, it's on the rise, but it's certainly not near the concerning points that we saw flip markets back in the day. Now, why is this all important? Well, I've heard from some mortgage lenders that are actually in our community that we're starting to see a claimed spike in delinquencies. And what they're doing is refinancing these delinquencies into these longer rate yields and basically just saying, okay, you can have 2 years of not being able to pay, and we will just stack that onto the back of your mortgage. So it's a totally different way of, kind of making people seem like everything's okay, but realistically they can't afford it. According to all of this, Bloomberg Economics global trade policy uncertainty is rising once again. Now, we saw this rise, of course, into the pullback that happened in February and March, and of course, expand really heavily at the top here, where we had the Liberation Day and everyone got super concerned. Because tariff, of course, has come back into the wording, then we are looking at a very similar type of potential risk-off style situation. Remember, nobody believes that Trump is going to hold these particular tariffs anymore. So if he does, the market has definitely not priced those in. So just be warned of that as we approach these very interesting levels. As we've talked about things like the Russell 2000, things like the S&P 500, things like the US dollar, all of them have shown correlation at the same point. Now, guys, I have to bring up silver. You know, I was pretty happy, and I'm sure a few of you were as well during the Friday trade action. Nice breakout to the upside. And I just wanted to kind of remind people of the craziness that people will start to say about things like silver and others. So 409 to 1. That is the amount of, for every 1 ounce of silver, there are paper claims. There are 409 paper claims, speculatively, on the silver actual ounces out there. And what this means is that if you converted all of those paper notes into physical silver, it would force a price of approximately $13,780. Now, I've seen some posts going around, such as things based on Grok, to say, using first principles, what is the most undervalued commodity? And it often comes back as silver. Now, I would say it probably has been doing that for 20 years. But do remember, time to own silver is very important. And as we mentioned 2.5 months ago on this channel right now, we believed it was getting towards that time. And that was based on ratios to gold. And this is the power of understanding this stuff, guys. It's about data, it's about flow, it's about psychology, and of course, it's also about ratios and understanding what the biggest people on the street do and when they tend to activate things and how long they activate them for. So silver was looking really good, as was Bitcoin, and both have had massive breakouts. So it's pretty awesome. Now, at the start of today's video, we talked about this analog, and boy, oh boy, is this wild. Nautilus Investment Research doing some great movements here. I love this type of thing. And you guys know that I've believed for a long time that we've been running a very similar narrative during the dot-com boom and the AI boom. And don't get me wrong, guys, the AI boom is going to be ballistic long term. If you're in AI and you have a 20-year horizon, 15-year horizon, even 10-year horizon, you're probably going to do pretty well. Now, in terms of where we are right now, though, remember we're in what we call the hardware phase. And this was also the infrastructure and hardware phase of the dot-com bubble. And remember, what happened at the end of the dot-com bubble were companies that made no money started to basically pop up. And the big one that everyone remembers is pets.com. If you're not familiar with that story, go check it out. There's so many stories, though, during that time. Now, another thing that happened around that period were IPOs went wild. And we're starting to see that once again, particularly in the crypto/AI space. But have a look at this correlation. We're running and we're coming into a point which, at least historically last time, was sideways, a pullback in time. So this makes sense with our whole Christmas in July kind of concept. We believed that the market would rally up throughout July and the end of June, and so far it has done so. Now becomes the time of question marks into this earnings season, because often you do start to see pullbacks or at least kind of sideways action. And that makes a lot of sense when we overlay year threes of bull markets. Remember, we had 20%, 20%, all sorts of different policy shifts. This is, of course, a post-election year. They tend to do this, and we can have some problems. But the question then comes back to, will we continue to see strength moving forward? Well, I think Nautilus did some great work here on this one, and you'll see a lot of bullish runs. We've had this way breadth thrust, 9 to 12 months. This happened a while ago, by the way, back in April and May. And we tend to see usually strength over that run. Now, what happens here, though, is that if you have a look at S&P gains after we get reads such as this, it kind of reads out that there could be still some problems. If you notice, a lot of these come at the beginning of epic rallies. So if we're at the beginning of an epic rally, fantastic. But some of them come near the tops. And this goes back to the historical data. And the one that really stuck out to me was this one here, the 1998 hit. Because there's a hit there that makes very clear, well, it's actually 99 here, but it's one of those ones that does continue on for 3 months, 6 months, etc. But then things go pretty bad. So we've got overlays with the 98-99 narrative. We have really gains exceeding 25%, which go over that narrative. And we also know that they either happen at the beginning of epic rallies that continue on for a long time, or they can happen at the end of bull run cycles. So the real question is not so much are we in the middle of something, it's whether we're at the beginning of something huge or we're at the end of something huge. And have a look at these reads. Meme coin platform Pump raises 600 million within 12 minutes. Pump.fun raised 600 million within 12 minutes on Saturday in its initial coin offering. The platform's co-founder, Alan Cohen, confirmed the public sale brought the total sale to 1.32 billion, which is a lot of money, of course. And it looks like here, this is basically a huge, huge rally in the space. He says, people run very hot and cold in our space. And of course, at the moment, you would have to say it's running pretty hot. So everyone's getting involved in the crypto markets at the moment. And you can see here that IBIT just accomplished something that took other market ETFs a long time. And that is to get the amount of size under funds. Look at this, take VOO. These are S&P 500 style ETFs. Thousands of days to get to this size. Bitcoin did it very quickly. So clearly the adoption is going on. People are loving leverage in this market sector and people are feeling FOMO. So to recap so far, we've got delinquencies and bankruptcies on the rise. Something to be looking at. Timing will be everything on those. We have correlation with 1998 as being the strongest correlation to the current stock market rally of the last couple of years. Interesting times for that because, of course, we know how that ended. We have the correlation as well of AI versus .com, and then we have the horrible leverage correlation, which basically means that everybody is starting to get into the markets. And you might say, well, everyone's already in there. Well, yes, but every bubble must be bigger than the next one. So leveraged exchange traded fund total, look at this, all-time highs. Let's have a look at this one. This one here is the margin statistics from FINRA. So nowadays, a lot of people are taking leverage inside of ETFs, but still getting towards all-time highs. We've got a new read on this coming very soon. And you may notice this happens every other period of time. So again, starting to think, well, you need to be aware of these things. And then we get the kind of bombshell of what may happen next year. Going to Deutsche Bank, strategist says Powell exit risk is underpriced. And I agree with this. People aren't really thinking about what will happen if Jerome Powell does leave next year and gets replaced with a massive cutter. So basically, it could be that we have a massive cut mount next year. Could be in the factor of like 6 cuts very quickly. And if we see that, then we could see all sorts of damage to the dollar and we could see a huge amount of treasury risk as well. So there's going to be a huge move, in my opinion, based on the dollar and treasuries next year. And this one, it could be one of those ones that they put in a book. So yeah, be prepared. We'll have a special on that moving forward. So make sure to subscribe. And just as a kind of more beautiful chart, you can see here this one from Tom Bradshaw, just showing again, investor credit inside of actual trading accounts, more and more leverage as everyone tries to chase it, along with net retail purchases of single leverage stocks quadrupling over the last couple of years, if not even going up 10 times over a 2-year period. So you might say, well, okay, everything's negative. Well, not necessarily. I mean, when you're led by technology, you guys know I'm a big fan of that. So semiconductors have been raising up. They've been bringing up the markets, and defensives have been kind of lackluster. And what this tells us is that this market is driven by growth. It's driven mostly by AI potential, and we're already starting to see people really believe in this. The latest chatbots are clearly showing the potential here of people losing their jobs. And of course, many of you in the community that are very smart, a lot of engineers out there, a lot of very high-end professionals, CEOs, all sorts of things we've got in the community. You guys have been messaging me, and I really appreciate that on X and other places. And you've been letting me know, yeah, your businesses are letting off people in real world because AI is starting to eat away at some of the lower end jobs, and you're hiring less. So does this make more profit? Of course it does. For the businesses, initially profit is up, but it obviously will be a huge problem to unemployment long term if we continue to see this. Speaking of which, let's look at the banks. The banks are happening on Tuesday. Now, this kicks off earnings season, and this is one of those rare ones where we get both the banks happening in a week and we get the beginning of the tech, which is usually kicked off by Netflix and then Tesla the week after. So we've got lots and lots and lots and lots and lots on debt coming through, so make sure to watch. And of course, be prepared for the implied volatility. So the banks are going to move more than normal, 5% on Wells Fargo, 4% on JP Morgan plus or minus. These are pretty big moves, but have a look at Netflix. It's expected to move 7 to 8% during the earnings up or down. So be prepared this year. This particular options market is going to move quite a lot. And a lot of Wall Street analysts have a lot of these new stocks, these hyper stocks at the moment at overpriced. So remember, if they don't get what they want, they're going to then downgrade these stocks. And whether you like it or not, that downgrade often makes them make big moves. So the most overpriced, according to Wall Street, is, of course, CoreWeave. Then we've got Palantir. Then we've got Coin. We've got Roblox, Net. These are all the favorites of the retail trader right now. And the markets are all saying, yeah, hey, well, they're overpriced here, according to Gainify. And this is the analyst price upside target. So they're basically saying, yeah, they're super over our upside. They're going to need to upgrade those. And now they may do so. And don't get me wrong, analysts are usually wrong. But at the same time, if they downgrade them, oh man, that could really start to bring some of these things off. So to make matters even more crazy this week, not only do we have the kickoff of earnings season and the financials, But guys, we have the kickoff of US CPI. So we have inflation coming back in. You might say, well, who cares about inflation? I tend to agree with you. But at the same point, here's the issue. It's tariffs. It's been about 4 months, 4 to 6 months. Like usually on the top end is where you start to see tariffs come in. So I said before 1 to 4, that's the general. And then of course we tend to get more and more and more coming through over a period of time in terms of inflation. So do we see an inkling of that? Does that create a risk off event at the trend line? I think it depends on your timeframes, and we'll go through that in just a moment. Just a quick reminder, if you haven't already, come and check us out over on LinkedIn. I actually post personally over there with a whole bunch of extra information. I'm posting another one on Monday, so make sure to check out that. And the links are in the pinned comment down below as well. And it's really awesome to connect with you guys. But there's some posts there that I think will absolutely improve your trading and investing journey. And that's because I've shared with you guys some of the ways that not only do you find bull runs, but also some of the things you should have been looking out and continue to look out for in 2025. And you can see that in some of my older posts. So make sure to give it a follow, connect with me if you want. It's awesome to see you guys on that platform. Let's now talk about S&P 500. You can see here that it's been rallying up and it's almost at that trend line. Now we're starting to see correlation here between the S&P, the NASDAQ, the Russell, and of course, the dollar index. But let's now look at the latest kind of here futures market action. You can see we're starting to see some sideways action as the market's having real problems with that 6,300 call wall area. We also have a end of pretty much that massive flag, and everything correlates between this next kind of 50, 60 points. And that's why we're kind of saying here, maybe into earnings, we need to have patience to react to the market to see whether the market really wants to rip up or not. As of Monday, we don't have that many kind of puts or calls in terms of we've just got the standard 6,300 calls and 6,250 puts. So I guess you'd have to expect the market to stay relatively flat. But then we start to get more puts as we kick off the bank earnings season. And this is going to come down to 63, 62. Now, I don't think that the banks are going to show any type of bad earnings. I have a feeling that they're going to be still pretty good because they'll be loving deregulation and thinking, man, people are going to be taking on more loans. So it's not so much that people are going to look at these banks and say they're bad. It's just whether they've got that worrying sign in it, whether Wall Street wants to use that as an excuse. Maybe delinquencies are up, who knows? Maybe they'll tell us something about that. But the key is going to be 6,300. So 63 could push way higher if it gets through there. But this is the call wall, and we've been talking about it for a while. We're right at that level. And it kind of, shows up in a lot of other stocks. Tesla, I guess if you bought the 290s the other day, you'd be pretty happy because it's back to 313. This stock's still stuck between like a 280, 300 on the put wall and maybe a 320, 325 on the call wall. We'll look at that soon. And then there's Nvidia. It's still been leading the charge with semiconductors. 165 plus opens up 175. If you're on the bull train, the markets are still rallying. The market's still making higher highs and higher lows. So things are still ramping up in that side. And of course, you will be at this point, if you're in semiconductors, feeling pretty good about the world. Because why wouldn't you? It's been doing very, very nicely. It had another nice week. Although, if things turn around, remember, they will most likely go back to what we call weekly mean reversion, which is the weekly 20 moving average. Let's now have a look at the bonds market. Are we seeing concerns? We saw a bit of a spike up last week, and they dropped off on the latest data. So if this keeps spiking up and we keep going sideways, that is usually a canary. So that will usually bring through more selling in the future, and it is a good early read. In terms of put call ratio, still more calls than puts, which again is good because if you want a bit of a market pullback, you need to see more calls starting to flood the market more. And US dollar has been rising up. As we suspected over the last week and a half, the US dollar has been strengthening. And we kind of expect that because, again, the media says, oh, the US dollar is dead and blah, blah. But realistically, what have yields been doing? Well, they've been spiking up. And this is actually a concern that the market, again, is not pricing in. Look at the US 10-year. It's almost back to some of those problems. Let's have a look at the US 30-year here together. And you guys know that I've got alerts all over the US 30-year at 5+%. Well, we're back there. But no concern. Don't worry, guys. Calm before anything. There's nothing worrying about this. I'm all cool with buying the market as well because the rallies are up. But you've got to be aware. A 5+% tends to bring out some of these the cleanup crew, and that could be the Fed. It could be Trump, who knows? Something's going to happen whenever you go past 5.1. Gold on the rally again, really nice. Looks like an inverse head and shoulders. Broke to 33.60 and then didn't close above, but still looks pretty good. But the real win was silver. Look at the squeeze. I'm going to give you a clap. Okay, everyone gets a clap for silver. Why? Because it's awesome. And why is it awesome? Because so many haters on it. And what I mean by this is if you look at any post on silver, oh, it's dead metal, blah, 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 blah. No one cares. So why does no one care? Because generally speaking, the flow has been going up. It's like the market right now. Someone could say to you, oh, delinquency's up, sell the market. Where is the flow looking bad? Where are we seeing the dark pools? Where are we seeing the reasons to dump off just yet? We just haven't got it, yeah? So it's great to know it, but you park it to the side and you follow that market movement for at least now. And I think silver's been a classic case of that. So many haters, so many non-believers on this across the internet, and rightfully so. One of the worst, crappest metals of the last kind of 70 years. It's been terrible. It's a terrible metal most of the time. But when it's good, it's good. And at the moment, that's a pretty mighty squeeze. So could we get that 42, 43 in the future? I'd love to see so, but don't expect it to be like a crypto and get there in a week. It takes months and months and months with an old thing like that. US oil rallying up. I have no opinion on that. I call it neutral. There's really not much to say, but we will still cover it. Tesla, as you can see here, 280, 290, 300, that kind of area. Yep, I can see buyers there. Weekly did pull up, but realistically, it's not through the problems yet. I'd say about 320 is the current resistance for that stock. And then we get over to semiconductors. So you'll notice here semis have had an epic rally. Now, if we actually took length, so what we'll do is we'll take the length of this last move to here, and then we'll extrapolate that out from both the bottom to the top. We get a little bit more distance, yes? The bottom to the top. And if you take like a standard flag like this, you'll get even further. So what that's kind of saying is if we do follow a 98 narrative, we've got that little bit more to creep up. Then we go maybe like this, and then we could potentially rally up higher. So semis still looking good at this stage. They're at an all-time high. You can't say they're not. And semis versus SPY is still on the rise. Now, I feel like this is where the risk is, and some people will take profits around this level coming into earnings because of all these reasons. But the main thing you're looking for in the future is going to be the weekly 20 moving average. So if we do see pullbacks, which we don't at this stage, but if we do see them, then we're looking for those mean reversions to the weekly 20. Chinese market tried to pop a new high, wasn't able to do so. I'd call this a coiling market ahead of potentially a breakout. And US 2K came under some hits as it hit that massive level of take profit. So that zone here, the supply on the left-hand side, that's a massive take profit zone, and it certainly did reject that space. NASDAQ also getting close to the trend line, so we're right around that level that makes sense into earnings. And of course, Ethereum, another benefactor of a bit of a squeeze here. Massive move up from Ethereum. I don't really see a resistance until 3,300 to 3,400, so there's maybe some more movement there. And Bitcoin absolutely stonking. Look at this thing. We suspected. You guys were smart. I saw you in the comments section going crazy about Bitcoin, and maybe rightfully so. That was a absolute textbook setup, and it was similar, in fact, to silver. I teach this in my day trading masterclass and advanced class. Links in the description down below if you want to learn more about that replication. And it is really replication. Guys, this isn't about your opinion. Your opinion means nothing, so does mine, yeah? It's not our opinions that matter. It is about understanding flow, data, and obviously that psychology that goes into it. And really, Bitcoin was a very similar situation. It had been going nowhere with a whole bunch of positive news, but it had been setting up. And it was all about that dry up in liquidity as well, in my opinion, which was caused by Wall Street. I mean, Wall Street, like everybody is setting up a business like MSTR right now, and it's just draining Bitcoin out of the system. And okay, it might end really badly, but remember, it's all about timing. Now, how high could Bitcoin go? So I said I'd do a quick fib. And basically what we're trying to do here, we're trying to just do an extension. So effectively, we've got a couple of levels. I think that 125 makes some sense here for Bitcoin. And what I also like to do is when you have correlation like this, so you've got this kind of market that's built like that, you usually extrapolate that out to the top. So let's do that more perfectly for the more OCD people, and you get kind of like 125. So I think 125 makes sense here on the Bitcoin initial move. Obviously, you've got people calling 4 million, 5 million, whatever. Yeah, okay, whatever. That's going to take a long time for those numbers. But in general, if it even happens, But in general, just remember, yes, markets can stay irrational longer than you can remain solvent. So I personally wouldn't be against Bitcoin right now. That's my opinion. We'll see what happens. Let's look at the week ahead. It is Monday, not much going on. Tuesday, heaps of things going on. We've got CPI, we've got the kickoff of the big banks. Then Wednesday's big banks, core PPI coming on Wednesday. And then, of course, we kind of just go into earnings season. So this is all going to be about earnings, a little bit of CPI, and more earnings. What have the banks been doing? Have they been making record profits? I believe they may have been. What do you guys think in the comments down below? Are they making big bank on the idea of deregulation and everything else? Remember, guys, to follow me on LinkedIn. Some excellent posts there, so it's always great to connect with you. I do hope you enjoyed today's video. Man, I'm getting excited about the rest of these next 6 months and 12 months. I really think the market's turned back into being incredibly technical, incredibly data-driven. And really the only problem with the market over this year, and we kind of suspected it would be, was the tariffs on, tariffs off. And what that did was it made you had to go back to the old, okay, buy when fear's in the street. But maybe over the last 2 months, been a lot better. And that's been awesome. So if you want to find out more about how to replicate stuff, check out the trading course as well. Thank you so much for watching. And guys, I hope you have a great weekend with your family and friends. Bye for now.